Tuesday, November 26, 2019, Maneco 64, home of alternative economics and contrarian views. This morning I want to talk about the Dow Gold Ratio and look at what it's telling us about the overall paper assets, financial markets, and the precious metals. Of course, gold having been a store value and money for thousands of years, it's important that we look at that Dow Gold Ratio. And before I go into that and into the markets, I just want to talk about a book very briefly that I've had for many years. And it's come to my mind recently because of what we're seeing in the markets, in monetary policy, in the economy, how crazy things are. I think the people involved in the financial markets, mainstream financial press, which to be honest, I don't watch anymore, but I can imagine what they're saying out there on CNBC and Bloomberg. I've heard Greg Manorino talk about the people on CNBC being like orgasmic about the new highs, right? This is the book here, Extraordinary Popular Delusions and the Madness of Crowds, written by Charles Mackay. He was a Scottish author, and he wrote this book in 1841. And this is one of the books that I've had for many, many years. It's how I learned about the Mississippi bubble, the tulip mania in Holland, and the South Sea bubble here in England back in the 1720s. So what's that got to do with the current environment? Well, I think we are in an extraordinary popular delusion. And what is that nowadays? Well, it's the delusion that central banks are all powerful and that the credit or money that they create out of thin air is worth something. And yeah, people don't realize that all the paper assets are how can I say, falsely valued, because how can something be worth something if it's created out of thin air, right? Money and value need to be created, right? They can't be conjured up. You can't create $1 billion worth of wealth by typing it on the New York Fed's system and then buying U.S. treasuries, which are also issued out of thin air, of course. Well, they're borrowed into the system and bought with this thin air money, which is supposed to, how can I say, help price all other real assets like stocks, bonds, commodities, right? Well, commodities is another story. They're undervalued, right? Mainly because paper assets are overvalued because of this extraordinary popular delusion that for now, most of the investors out there, most of the crowd out there, most people still think is worth something. But there will come a moment when that bubble bursts. And highly recommend this book. As I said, written in 1841. I think this is the 1995 edition. So, introduction here. Norman Stone, professor of modern history, University of Oxford. This is what he says. Some very odd manifestations have appeared in the 20th century. Global rivalry and nationalism, genocide, and despoliation of the planet have all left their mark. The rise of fundamentalism in the three great monotheistic religions has produced extraordinary political rhetoric, warfare, mass murder, and suicide bombing, and all the miseries that attend strongly held opinion, unenlightened either by intellectual diffidence or toleration. The business world has been rocked by greed, and in recent times in London, the odious Robert Maxwell was able, by a mixture of bluff and threatened legal action, to destroy the lives of thousands by pulling the wool over the eyes of investors and bankers in a way that makes the unjust steward look like a paragon of fiscal probity. So this is from 1995, this introduction, right? So need a new edition. And they need to talk about how central banks are now the Robert Maxwell's, right? And with that, I just wanted to show you, I saw an article actually on Zero Hedge from 2015. It says why the 1%ers hates the gold standard, or hate the gold standard, right? Because the 1% is plural. I would say is they hate the gold standard. So this chart tells it all here. Income growth from 1917 to 2012. You can see the top 1% up until the early 70s or so. Their income growth wasn't that great, was it? And then since Richard Nixon took the world off the gold standard, or the gold exchange standard, if you want to call that, the Bretton Woods, but it still had some semblance of a gold anchor, right, and sound money. Look at what happened after that. The blue line is the bottom 90% of earners. They didn't do very well like in the 20s and 40s, but after the war or the beginning of World War II, you see that group doing very, very well. But since Nixon closed the gold window, you see there, it hasn't been a great time for the bottom 90% in terms of real income growth. And the central banking system has allowed that. Of course, the monetary system has allowed that as well. It's been the bankers and the politicians together doing that. That's why debt's ballooned as well. So that's the popular delusion nowadays. So now let's look at the Dow Gold Ratio. I'll first show you a long-term chart of the Dow Gold Ratio going back to the early 80s. And you can see that we got near 1 back in 1980 when gold topped around just above 850 in January of 1980. At the time, the Dow was around 800 or so. So that ratio is 1 to 1. That's when the system reset. And I've said many times, that's when the system will reset again. When we get back to 1, at what price that will be, I don't know. It could be 30,000. It could be 2,000 to 2,000. You might say, how can the Dow go back to 2,000? Well, who knows? It could be anywhere, right? I don't know where the ratio... I know the ratio will rebalance back to 1, but I don't know where the prices will be. So you can see that in 99, 2000, when gold bottomed around 250 and the Dow got up above 11,000, that ratio got to almost 45, as you can see here. This is a medium-term chart. And we got down to around 6 in 2011. And this is an interesting Fibonacci retracement. And look at that old 61.8, right? People say technical analysis doesn't work. But there you go. Yes. And now I'll show you a shorter term chart so you can see what's happening here in terms of this head and shoulder that we have here as well, as you can see in the medium-term chart. So I've talked about this head and shoulder. We tested the neckline back in August time, and it's rebounded off that with the stock market rising, with the repo market, with the Fed saving the repo market, with the Fed starting QE again, right? That's helped paper assets, but I'm not sure we will be able to see that ratio go further up. It looks to me like it's kind of losing momentum. And you can see here going back in the beginning of 2018 that that ratio topped around 20. So I think we might see stocks continue to do well and gold stay under pressure. But I think the trend is down as well in this ratio, which will mean that gold will outperform. Yes, and I've made videos in the past, and I'm saying it again. That's when the reset will have happened. That's when Justice will be reestablished in terms of value. Things will be balanced out one to one. The system can start moving again, hopefully under a more responsible sound money system, maybe without central banks. Maybe that's a bit too much to hope for, but at least some connection to something real, something physical like gold. And it's weird because the leftists and even the right wingers, or the left and right, they talk about doing things for people, and but they never mention the gold standard and how the bottom 90% did so well under that system, how their income was growing so well. If you tell people, oh, we need a gold standard nowadays, they say, oh, that's going to kill growth, that's going to kill the economy. But it's not true, as you saw by that chart from that zero hedge story, right? So let's go have a look at the market, see what they're doing this morning. It's 8:30 a.m. London time. Of course, just go through what happened yesterday before I start. We closed at all-time highs for the Dow, S&P, and the NASDAQ composite. I mean, I'm not going to show the charts, but if you turn them around, that's the chart of the dollar, right, versus those indices. So just think about that. Is it the dollar that's dropping, or is it really the stocks that are going up? So yeah, the Dow finished above 28,000, was up almost 200 points, right? So let's see what's going on this morning. Gold and silver, of course, were under pressure yesterday, which is normal with people going on to risk assets. Right now, gold is up just under $2 at 1456.80. Range has been 1451.60 to 1457.73. Silver is up 4 cents, 16.92. Range has been 16.80 to 16.96. The Dow is up 12, so basically unchanged. I guess many years ago that would be a pretty significant move percentage-wise, but it's not. S&P is unchanged, so NASDAQ is unchanged as well. So what drove the market yesterday? I think we can safely say that right now this trade thing has been priced in, kind of. I saw someone saying that the fact that there's no more news about the trade at the moment is good for the markets. But I think this is what drove the market. Boom time back as deal making hits 70 billion in a day. U.S. stocks hit new records thanks to return of animal spirits and ebbing of recession fears. Is that so? Companies unleashed a wave of global takeovers on Monday, agreeing more than 70 billion in deals as multinationals targeted the booming U.S. market to squeeze out competitors and find new sources of growth. Industry leaders such as U.S. discount brokerage Charles Schwab, French luxury powerhouse LVMH, Swiss drugs company Novartis, and Japanese conglomerate Mitsubishi all snapped up rivals to extend their dominance over the sectors. The shopping spree suggests that a deal-making boom across the corporate world remains intact after a pause attributed to shrinking confidence among executives and fears of a slowdown in global growth. Instead, decisions by U.S. and European central banks to cut interest rates even further in recent months and do QE, right, have propped up stock markets and extended the availability of historically cheap borrowing or cheap credit, right? So that's what's happening there. It's nothing really, it's just hope, right? And cheap money. Okay, let's see what else is going on here. In the foreign exchange market, sterling is down a little bit today, down 0.2. It was up yesterday a little bit. It's at 128.74. The euro hasn't really been moving much. It's unchanged, 110.13. Dollar yen, likewise, 108.90, unchanged. Dollar's a little stronger here against the yuan, 0.1 0.1% at 703.52. WTI, fairly firm, but not going anywhere really. Crude oil is 57.90, Brent 62.67. Finish off, let's look at the bond market, see where the 10-year yield is. Well, 10-year yield hasn't really moved up that much, even though we're at all-time highs. The Fed's cut rates 3 times this year. The Fed's injecting hundreds of billion into the repo market and into its balance sheet through QE. And the 10-year yield is down 2 basis points at 175. So that's what, to me, is the madness these days. And it's an extraordinary popular delusion that you can have the stock market at all-time highs, the Fed cutting rates 3 times, the 10-year yield below 2%, the Fed funds almost down to 1%. If you had told me that in the 1990s, early 90s when I started out in the city, or mid 90s when I was in the markets, and even early 2000s, if you had told me that, I would have said you're crazy. How can that be? And that's why it's frustrating, I guess, sometimes, but you need to be patient. I know this is not going to end well. So to finish off, I just wanted to show you a chart from the Federal Reserve Bank of St. Louis. It's the effective federal funds rate, or the Fed funds rate, and what the economy does every time the Fed goes, or almost every time the Fed goes on a rate cutting cycle, right? And this is from 1955. You can see that every time the Fed starts cutting rates, we see these little shaded areas. Well, these are recessions, right? So there are some times, of course, that they do cut rates, like in 66. They cut rates and then they stopped and raised, and there's no recession. Yes, we can see that. The only problem with nowadays, I think this is what the Fed's hoping, that they've cut rates and they've averted the recession. They're going to maybe be able to raise rates again. But this expansion, as you can see, has been one of the longest in the last 60 years. If you enjoyed this video, make sure you hit the like button. Make sure you share this video far and wide. Subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. Billy and I wish you all a great day. Take care. Bye.